This is a continuation lesson for those who have taken our CD course to learn option trading techniques. As new opportunities arise, we update the course so that previous students have the best tools available to continue to make money using our low stress techniques. Using stocks with spreads of $1 strike prices can be a very useful tool in a number of situations. This table is for the stock RIG, which has a strike price spread of $5. When we normally set up a credit spread position, we have a strike price difference of $5 for a large portion of the stocks that we trade. This requires that an insurance technique be placed to limit our loss if the stock reverses direction. We never hold both parts of a spread during a reversal, because the long position will remain stationary when a smaller move occurs in the stock, but the short put position will increase in value, causing a loss in the position. The chart of RIG shows that we set up the position at exactly the right time, but after a short run, the stock is showing signs of a possible reversal. If our position consists of the 85 put and the 80 put, we have risk of $500 possible at this point. If the stock drops to $85 a share and we exit the trade, we will lose about $132 for one contract. The short option increases in value to $147, and because the long option is so far away from the current price, its price doesn't move at all and remains at the price we paid for it, which is 15 cents. There is a growing number of stocks that have a $1 spread between strike prices, giving us room to perform our trades differently. Here are a few stocks that we have traded in this category. There are lots more. This is the option table for the XLE. Note that the $1 strike difference continues throughout the entire price range. The XLE is trading at about $58.50 a share at the moment. We will set up a trade using the 56 and 55 puts with only about 10 days left in this option cycle. This will be a credit spread. So we will sell the 56 put for $1.18, and that will be our short option. Then we will buy the 55 put to limit our risk for 74 cents. That's the long option. Our potential profit will be 24 cents if the stock stays at or above $56 a share. That's a gain of 31%. We like these kinds of trades, but let's look at the downside risk for this position. Our risk can be a maximum of 76 cents or $76 for one contract. So far, this trade looks like many we have done in the past. So what's the big advantage? The simple answer is we have lots less risk if the stock reverses on us. The chart of the XLE shows that we had a red bar on today's chart, so we could be facing a reversal. The red arrow shows the ETF could have a short-term drop to 55.50 or thereabouts very easily. Or it could drop to its last support level of 54.50. In the extreme, it could go down to a previous support level of close to $51 a share. We can protect our funds by placing a contingent order to exit the short option only if the ETF approaches $56 a share. This is where our $1 spread will prove its worth. If the ETF stays right around $56 a share, our exit price will probably be about $1.70 for the short option. But the long option will also now have some gain, giving us a loss of 35 cents or $35 for one contract on this portion of the trade. So far, it's no different from a $5 spread. Our advantage is that we gained a small amount on the long option at this point. But this is a $50 trading instrument, and it could easily move $2 or $3 in its normal trading range, or if the Dow has a bad day, it could participate. Remember, a rising tide or a lowering tide carries all boats. We made 24 cents on the original position of the trade, and when that is subtracted from our loss on the reversal, our real loss is reduced to only $11 for the entire one contract trade. Now, if the ETF just drops $1 more, we are back in the profit range again. If the ETF keeps moving down, our profit keeps growing and growing. Our profits would become significant if the ETF continues down. If we were in a $5 spread trade, we would be just beginning to show a small profit at this point. With $1 strike spreads, we get a very large gain and a much smaller loss if the stock only makes a small move down. Even though this table looks attractive, remember that once the situation described occurs, you are going to become an active trader, and worry and fear will become part of the trade. This is a good way to get the action associated with an iron condor at a low cost, and may also be a better way to play an earnings announcement. But don't look at this as a way to increase your profits, but as a way to limit your losses or reduce the number of losses that may occur. Thank you for taking the time to watch this video. If you haven't taken this course and are intrigued by these techniques and our unique timing methods, go to our website and order the CD. It will make you self-sufficient in all aspects of making money the low-stress way. Good luck, goodbye, and happy trading.